Cryptocurrency, what a volatile market. Don't you just hate it when your portfolio goes up massively or a particular position goes up 10x, only to then see it come right away back down, only wishing that you sold near the top? But what if you could identify the top before the top occurs? Well, that's what we've covered in this 9-part series. Today is part 8. Part 8, and the last part we showed you how to identify that top, but we're going to cover a bit more of the nuances today. If you don't know me by now, my name is Jagir. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. Been featured in the best-selling book, High Probability Trading Strategies, back in 2008, where I only used to focus on currencies, but now exclusive on cryptocurrency. At R15, we focus on increasing your financial health through simple crypto and blockchain education. So if you like the content, do like. It really shows your support for the channel and it means a lot. But we've got some valuable content because we're going to focus on wave 4 today. Top of a wave 3, which is the beginning of a wave 4. And we want to know what is the typical wave 4 ratio, which you can identify in advance, so managing your expectation, but also what action you should take in an objective, mechanical, non-emotional fashion. So let's dive straight in. So today is part 8 of this 9-part series, and we've covered a lot so far. We covered momentum on the weekly and the daily. We covered pattern on multiple degrees. And now in the last video, we said, all of this was a high probability zone and how we identified it in advance, because we did. We did it in June, July in 2021 of Solana. That's the example that we're using, and how you could have captured all of this 1,000% to the upside or coming up towards 1,000%. Now, what we're going to focus on today is the end of a wave 3 and the beginning of a wave 4 to the downside. Now, I showed you how you would have exited this in the last session in part 7. But in part 8, we want to know that wave 3, if we measure wave 1 and project it from wave 2, this is a wave 3 Fibonacci price extension, which we covered in part 7 in the last part. This is what you call an overextension. This is panic buying, FOMO. Look at the rate of change. It's just almost vertical, right? Almost vertical. So we want to go, okay, the buying power is gonna run out. It's gonna run out, and especially when it exceeded this amount. So you should be taking profits and then exiting at this point. So now, what we're gonna look at next is wave 4, right? Wave 4, which hasn't been confirmed yet, but we've got a momentum indicator. So something we got over here, which is very valuable and very powerful, is something called a divergence. Yes, divergence. A bit of bonus information for you, but it's important to know. When this high and this high, it goes lower. You can see it's going lower, like literally to the downside. That indicates that the market is losing strength. But in the same time period, the price has gone up. So that's why it's divergence. One's going up and one's going down. So it's telling us conflicting information. That tells us we're probably going to see a price reversal. Combine that with the fact we've hit the overextended 2.618. Very, very valuable, important information. So now what we're going to do is we've exited this already. We would have seen that in part 7 of this 9-part series. What we're going to focus on is we're going to get rid of this now. We're going to now assume that this is the wave 3 high. And we don't want to trade wave 4. Wave 4 is a typical profit-taking wave. We want to stand aside ideally and wait for a potential trend reversal for a wave 4, and then potentially look for another buying opportunity to ride the wave 5. Or if you want, you can hodl, as in hold on for dear life during a wave 4 and then ride the wave 5. That's a decision that you will need to make. But if this is a wave 3 high, a typical wave 4, we want to basically do a retracement of wave 3. We're going to click at the wave 3 beginning and the potential wave 3 end. 2 clicks on using the Fibonacci retracement tool. So we're using a software called TradingView. It makes our life very, very easy. So I'm going to click this low down here. Make sure I get it right. And we're going to click this up here. And the key ratios for our end of wave 4, measured for a wave 3, of a wave 3 is 38.2%. It's the typical, more often than not, ratio. 23% we want to be aware of, and 50% we want to be aware of also. Typical maximum is 62%. Now, one of the rules of Elliott waves is that a wave 4 should not trade into the range of a previous wave 1 high. So in other words, wave 4, we expect a correction, profit taking, but it should not go into the range of the former wave 1 high. Right, so that's the absolute maximum test, but most common is a 38.2%. What also helps us to see at end of a wave 4 is wave 4s are more often than not in 3-wave corrections, and when wave 2 is sideways, and you can see this is a pretty sideways wave 2, right? It's gone sideways. Even though it's in 3 waves, it's pretty sideways. It's not sharp to the downside, and there's something called the principle of alternation. When wave 2 is sideways, wave 4 tends to be quite sharp, and wave 2 is quite sharp to the way down. Wave 4 tends to be sideways. So we should anticipate a pretty relatively sharp wave 4. We're also going to bring back up the momentum, right? Because normally, more often than not always, but wave 4 will always, not always, more often than not, coincide with a bullish reversal. Sometimes it's one, like it goes down and then up, and other times it's up and then down again, and it's the next reversal. But what we're looking for is a confluence of events. We're looking for a pattern, we're looking for price, and we're looking for momentum. The exact same way we saw wave 2. So now let's unfold this data and let's see what happens. So as we unfold the data, we see that, first of all, this is really, really important to understand. W.D. Gann, one of the forefathers of technical analysis, called this overbalance of price. Now, a wave 4, which is, this is what we're talking about, or potential wave 4, should be bigger than any former correction to the downside. And you can see the biggest correction to the downside was probably this one over here. So you can see already that this is clearly bigger, right? This is is much bigger. So that's our first indication that this wave 3 is going to hold as a wave 3 and that we are forming a wave 4 low. But we haven't seen 3 clear waves. So I would always anticipate at least 3, ideally, more often than not. We had a move to the upside and then a move to the downside. This is now coinciding with a bullish reversal on the momentum. So you can see that this momentum, if I go over here, the blue line has gone over the red. Oh, let me just jump back in here. So now we could see this as a A, B, C correction coming towards the 38.2%. So it coincides, it matches up and it marries up. That's looking good and is looking healthy. If we use candlesticks, now there's a couple of things you can do here. Because the momentum is now bullish, you can look to go long, as in buy. But to be honest, you might do that, you might not do that. But what I really want to focus on is a couple of things. Let's just go a bit lower. Okay, now we are in the range. We've got one more bar. We've tagged the 38%. The momentum is still bullish. Let's just double check. Yep, it's still bullish, so it's looking good. So now what you could do is, because we've got pattern, which is now what looks like a wave A, B, and it looks like a wave C forming. A few other things we can do. Let's just unfold one more bar. Boom, we got a green bar. Now it coincides. So now what we're going to do is we're going to look at this as a wave 4, a potential wave 4 low. Right, it's bigger than any former correction. It's hit the 38.2 and we've got a big green bar. So now we can pop in this. We can remove the question mark. That looks good and healthy for a wave 3 high. Let's go back to our line chart so it makes it easier for us to see. And we can pop in, if I can grab this, here we go. And we just want to change that to a wave 4 low. So there you have it. You got a nice wave 4 low. The closing data is tagged the 38.2%. If this low holds, it means we should anticipate the high being exceeded. The high being exceeded of the wave 3 for another surge to the upside. So it's looking healthy. Now you would want to have a strategy to buy at end of a wave 4, which is the beginning of a wave 5. We could do a couple of other things, which I'm actually going to do before we wrap up, because this is part 8 of this 9-part series is just like the wave 2 that we did. We could go into a lower degree time frame, which we're not going to do today, that this normally breaks down to 5 waves. But this wave A and wave C often have a nice relationship to each other, and it's normally 62 to 100%. So we can do an alternate price projection called a fib extension also. And the ratios that we want is 62% and 100%. And look at that. Look at that with the 100%. It's coincided with the 38%. So this tells us it's very significant. We got an ABC of a potential wave 4. We got a retracement of wave 3, which is 38.2%. We got an alternate price projection of a wave A of 100%. So now it's telling us this is looking very good. We've also got the bullish momentum reversal, which we saw. So now we've got a strong confluence of events saying this is looking good for a wave 4, and we should anticipate a wave 5 high, which will look something like this. So in our next lesson, the final part, part 9 of this 9-part series, we're going to project in advance with high probability the end of a wave 5 of this whole new trend that we've identified in advance. This whole big movement, which we identified down here, we rolled up here, exited up here, was patient down here, potentially entered again to see how far is it likely to go and what should we anticipate after a 5-wave movement to the upside. So if you like today's content, show your support for the channel, give me a like because it means a lot to the channel. Also, take my free Elliott Wave and Fibonacci Masterclass. It breaks everything that we're covering in this 9-part series down step by step so you can understand the 3 key rules of Elliott Wave and how to read the markets like a pro so you can see this movement where you're 2 steps ahead of the market, where most people are always 2 steps behind the market, which increases the probability of you winning the game. All right, let's finish on a quote from my book. The quote of the day is Henry Ford. Henry Ford, legendary guy, revolutionized the automobile industry and the way we travel around the world today. He said, I want to listen. He's a wise guy, right? Wise guy from the early 1900s. It has been my observation that most people get ahead during the time that others waste. Cryptocurrency, blockchain technology is going to be bigger and is bigger than the internet itself. It's the next iteration, is Web 3.0. And this is here to stay. And we are at the beginning, like only 12 years in, to this $1 trillion trend. And mass adoption is probably still going to take another 5 to 10 years. So by learning and sharpening your axe, it allows you to get ahead of most individuals that doesn't even know that Elliott Wave and Fibonacci exists. So keep practicing, keep sharpening your axe. And by just doing this consistently over time, like driving a car, you'll get better and better and better and increasing the odds of your success. So next up, we're going to go for the final part, part 9 of this 9-part series. We're going to focus on the end of a wave 5 and what we should anticipate as a big correction to maximize your profits and then get out of the market. Like time to sell and what typically happens time and time again just based on the human emotions of fear and greed. All right, I'll see you in part 9 in the next lesson. Take care. See you soon.